Are American consumers under strain? Welcome to Market Insight. I'm Thomas Warner. Treasury yields popped on Wednesday ahead of Friday's PCE inflation reading, with many investors cutting bets that the Fed will lower rates at all this year. But there have been signs that despite a strong labour market, the American consumer is finally feeling the pinch. Poor earnings from the likes of Starbucks and Target contrasted with Abercrombie & Fitch's bullish forecast today. So are consumers about to crack? Let's ask David Sekera, Chief US Market Strategist at Morningstar. Very warm welcome to you, David. Great to have you on. Let's start with that first question. What is your reading on the US consumer?
Well, I think it depends on the individual type of consumer. I mean, low-income consumers, have really been the first ones about a year and a half ago to really feel the pinch from high inflation in the United States. What I'm thinking is, this quarter, what we really saw, the first real signs that now the middle-income consumer is also beginning to feel that compound impact of inflation, over the past 2 years. Initially they were able to offset, a lot of that high inflation as they had excess savings from the pandemic. That's now been all used up, and they've been eating into their savings rate. But at this point, the savings rate in the U.S. is getting to the point where I think it's actually below where it was, pre-pandemic. And what we're really seeing in the short term is, the worst hit areas are those that the categories that the consumer considers to be more on the indulgent side.
So, David, why do you think we are seeing such contrast in retailer earnings?
Well, I think the real big difference is going to be, in those indulgent type items. So, for example, Starbucks, they reported a 7% decline in foot traffic, really led to some very poor earnings, at Starbucks. And I think it's the type of thing where, people are either, having coffee at home or they're just, skipping kind of the latte in the afternoon altogether. But we even saw, McDonald's report what I consider to be relatively weak results. And even something like Tyson Foods is indicating that they're seeing a shift in consumers, away from private label brands into branded products. People are eating at home more often. And lastly, I just note, we're also seeing consumers, trading down to discount retailers, such as Walmart. So Walmart saw a pretty decent increase in foot traffic, and I think a lot of that is new customers, which in the past probably would have been pricing in, shopping at, full price retailers. Whereas someone like as a Target, which we don't believe has the same value proposition as a Walmart, is seeing slower sales, especially in their discretionary products like the household goods area, where a lot of those purchases can be delayed.
So Walmart performing very strongly, as we saw a couple of weeks ago with their earnings. Another name that's been on everyone's lips, Nvidia. It's fallen today, but it did come within striking distance of Apple's $2.9 trillion valuation on Tuesday. Fidelity thinks that it and others in the space are too expensive. Do you agree? And if so, why?
Well, I think when you think about like Nvidia and Apple, that's really why, over the past, 6 to 9 months, I've really been breaking tech into my own mind into 3 separate buckets. Looking at what I consider to be new tech, those companies are going to be levered to AI and cloud computing. Traditional tech where, they still have, long-term secular growth, but I think they're going to be under pressure for the next couple of quarters as we're looking for the economy to be, relatively stagnant. And then what I consider to be legacy tech companies, those are the tech companies where their best days are probably, well past. They're in a long-term secular decline, companies like IBM and Hewlett-Packard. But specifically, looking at Nvidia, we do think it is fairly valued. It trades at 3 stars. We're looking for another 4 to 6 more quarters of pretty high demand, where that demand will probably outpace supply for their AI GPUs. And I'd also note too that their guidance for second quarter revenue was up 7.5% compared to the first quarter. So I do think that leaves room for Nvidia probably to be able to beat again when they report in the second quarter. Net, when I look, our earnings estimate for this year is $28.04 per share, goes up to $39.33 next year. So on a multiple basis, it is a little on the pricey side at 37 times, this year's earnings. But when you look at next year's earnings, it falls down to 27 times, which is probably appropriate for a company where we're looking at a 3-year compound annual growth rate of earnings of being 58%. So I'd say for investors, the thing I'm probably going to be watching for most closely over the next couple of quarters are going to be, when their cloud consumer customers, start to slow CapEx spending, that might be an indication of Nvidia's growth rate, has likely peaked.
David, let's get your valuation on Apple. It still sits in second place behind Microsoft in terms of market value. Will it stay there?
Well, I put Apple into that traditional tech category in my own mind. It trades at a 12% premium to our fair value. That puts it in two-star category, meaning we do think that stock is overvalued. Generally, I'd say looking forward, we're expecting a flat revenue growth for this year, slowing iPhone sales. Apple's having to resort to discounting, in China to be able to move its product. And generally, I'd say there just really hasn't been any new innovative products that are going to be meaningful to earnings. And we just are waiting to see what they're going to announce as far as their intentions, for AI. So at this point, at 29 times our 2024 earnings estimates, I think that's getting to be pretty fully, if not overvalued, for a company where our 5-year earning compound annual growth rate is only 12.7%.
I see you're not too impressed with a new, thinner iPad, but let's see how impressed you are with Costco. They're reporting tomorrow. What do you think people should be looking out for?
Well, Costco, this is one of these stories where there's everything to like about this company except the stock price. We rate the company with a wide economic moat, meaning we do think that they have long-term durable competitive advantages. We rate the stock with only a medium uncertainty rating. Long-term, we're looking for top-line growth of 7%, earnings growth of over 10%. And as far as earnings expectations, we don't foresee any problems here in the near term. Their customers typically are going to skew to the higher end as opposed to the middle or lower end. So I think spending there will be just fine. But right now that stock trades at about 50 times our 2024 earnings estimate, which in our view is just way too high of a multiple for this company.
David Sekera from Morningstar, thank you very much indeed for your time today. It's been a pleasure. That is your market insight. Don't forget you can watch more videos on Reuters.com.